It is day one of a partial federal government shutdown. And if you're like most people, chances are you didn't see this one coming. Stocks ended the day higher. Here's what a congressional stalemate and failure to reach a budget deal looks like in Washington. 2/5 of all government offices have been shuttered, including all national parks and monuments, medical research projects put on hold. 800,000 federal workers furloughed, told to stay home without pay. And President Obama warning Republican lawmakers about how harmful past shutdowns have been and why Congress needs to reopen the government, restart federal services, and get people back to work.
We may not know the full impact of this Republican shutdown for some time. It will depend on how long it lasts. But we do know a couple of things. We know that the last time Republicans shut down the government in 1996, it hurt our economy. And unlike 1996, our economy is still recovering from the worst recession in generations.
Meanwhile, on Wall Street, here's how the shutdown looked.
Federal government shutdowns in the past, the last one in 1996. So how have the markets reacted in previous budget impasses? And what if this standoff lasts longer than traders are counting on? Dominic Chu joins us now with a look at how the markets have reacted in the past and whether a shutdown may be good news or bad news for investors. What'd you find out, Dominic?
Well, Susie, Tyler, take a look at this. I mean, it happened, right? The government shut down, not completely, but it did for a lot of employees. For the most part, the market seemed to shrug it off. All of those major indices posted gains. So just how much does a government shutdown really matter for stocks? Well, analysts and economists at research firm IHS estimate that the U.S. will lose about $300 million of economic activity each day. They go on to say that a week-long shutdown could shave 0.2% off economic growth in the fourth quarter. Now, other economists say that a more prolonged shutdown will take a greater toll on consumer confidence. In other words, the longer any shutdown lasts, the incrementally worse consumer spending could be. So with stock markets, with trading around government shutdowns, we took a look at the last 12 times it's happened, going back to 1978. Now, on average, the uncertainty leads to losses in all three major U.S. averages a month prior to the shutdown. But fast forward to a week after each shutdown, on average, the Dow was up 1%, we'll call it. A month later, that gain was nearly 2%, and a year later, the Dow was up an average of, get this, 15%. Same thing for the S&P 500, up 0.5% or so a week after the shutdown ends, up 2% a month later, and 15% a year later. And how about the NASDAQ? It's actually down marginally a week after a shutdown, up marginally a month later, but get this, up 20% on average a year later. Now, the caveat here, guys, is that we're obviously seeing other moving parts to all of these different markets simply besides the shutdown. But still, this would be one reason why investors aren't all that concerned. Now, of course, with the debt ceiling debate, that's a complete other story.
Maybe we should shut down the government every year if you get that kind of return.
And get some
19%
gains, right?
on NASDAQ.
There you go.
I feel a lot better already.
Yeah,
Thanks,
Dominic
Dominic.
Chu, thank you very much.